Good morning, everyone. This is Corey Hinkle with your Ankerstar Wealth Daily Update. I've got a market update for you. We're going to look at a big earnings report from Salesforce. I have the biggest risk for retirees, and we're going to walk through the IPO graveyard that has been established this year. So it's kind of like IPO RIP going on out there. But first, I do want to mention this is a financial education presentation. You must do your own due diligence before acting on anything you hear in this presentation. More disclaimer information can be found on ankerstarwealth.com, and the opinions expressed are mine and mine alone. All right, jumping into a quick market update. You can see the S&P 500, the Dow Jones, the NASDAQ all up nicely. Small caps leading the way. This is a little bit to be expected with the anticipated Federal Reserve rate cut coming next week. I will jump over to the S&P 500 a little more closely. You can see that we gapped down on September 2nd, and we have fully recovered that gap. So presumably the market is wanting to head back to all-time highs. Is that going to coincide with the Federal Reserve rate cut? We'll see. And we'll see if we get there, but nonetheless, the bull market ingredients are still there. And, the market wants to move higher, all things considered. Jumping over to Salesforce, though, Salesforce is continuing that trend that we've seen where software stocks are just heavily out of favor. We mentioned on the show before, Salesforce was a market darling for probably a decade plus and has been anything but that in the recent couple of years. Salesforce did achieve 10% revenue growth for the first time since early 2024 in this quarter. But they are viewed similar to how Google had been viewed in recent months and in Adobe, where AI was more of a threat to their business than being a benefit to their business. Google has been one of the companies we've seen who has mostly overcome many of these fears. But an Adobe, a Salesforce, a ServiceNow, and some other of those software companies out there, they have not been able to shake that negative narrative yet. And I don't know what that looks like for Salesforce. You do have to recognize that Salesforce has one of the most prolific CEOs running the show of almost any company out there. Mark Benioff has met every challenge that Salesforce has faced over the years with even greater success. It would be hard to bet against Mark Benioff here, but at the same time, it's just hard to see, are the AI threats to software business like Salesforce real and justified? And what does it look like? Investors really don't know what that looks like. And of course, when that revenue growth, which we've seen on the show before, when that revenue growth goes from 30% to 20% to 10%, and then now you're down in the single digits with a high valuation, the market's not going to like that. So Salesforce still in the doghouse. They are up off the lows of the day, and they're not at a 52-week low today. So we'll see what the market ends up doing with that stock moving forward. I did just want to show here, this is that software application section of the S&P 500. Again, under continued pressure for quite a long time at this point. And hey, look at those financials. Wow. All right. Jumping over to the labor report, labor market growth slowed dramatically, a little bit, of an aggressive headline there. I just want to mention this. Economists predict unemployment rate inched up to 4.3%. The Federal Reserve, looking at their dual mandate of employment and price stability, they are not going to view unemployment at 4.3% as being some existential threat to the economy. Now, of course, the trend being moving in the wrong direction can be scary. Some folks more scared than others. But all things considered, from a historical perspective, is a 4.3% unemployment rate a huge threat to the economy? And the answer to that would be no. The trend could be a little more scary than the 4.3% itself, but for now, it's not nothing. but it's not the end of the world for sure. And I mean, you see the market is up today. The market really couldn't care less. All right, I want to jump over to retirees' biggest risk would be inflation. There's really, that's what this person is saying, and this is the person who invented the 4% rule. So there's really going to be two main risks, inflation being one of them. The other would be really bad stock performance right after you retire, like those first 5 years after you retire. 5 bad years in a row, which it's not really something we've seen, but if you stacked a few negative years right at the beginning of your retirement when you're first pulling money out of it, it can stunt the growth of the account in a very meaningful way. I'm going to jump over though and talk a little bit more about the actual inflation risk more than that. So what's so painful about inflation for retirees? And at Ankerstar Wealth, we help folks through these processes all the time. All the time. And I'm going to walk you through just a sample scenario, and I'm going to try to articulate where the inflation danger comes from. So let's say you're a family, you're a single individual out there, you've retired. Let's say, and I'm going to stop sharing for a second. Let's talk about this. Let's say that your annual expenses are about $50,000 a year, just a round number there. And let's say you're getting Social Security benefits of about $40,000 per year. So you're going to need to pull $10,000 or so per year from your nest egg. And let's say your nest egg is $200,000. So you'd pull 5%, that'd be $10,000, and you'd be able to pay all of your expenses for that year. But let's say that inflation ran at 10% for that year. So now your expenses have increased probably to $55,000, and your income, inflation-adjusted income from Social Security, is going to be $44,000. Now, what do we know historically? Historically, when inflation surges in the United States economy, that's not great for risk assets like stocks. In the short term. We saw this in the 1970s. We saw this in 2022. This is kind of a common thing. So if you had to pull your 5% to meet your expenses in the first year, and now your gap has widened, it was a $10,000 gap between your expenses and your Social Security pension income. Now it's an $11,000 gap. But at the same time, you've gotten poor returns or even negative returns because of the uncertainty that inflation pushes into the economy. You could now be pulling a 10% higher number 1 year later out of an account that is actually down, maybe sitting at $170,000, whereas you had started at $200,000 before pulling out the first year's need. So this is where inflation can be really dangerous. This is something that we speak about with clients, and we plan for and plan around. It's also a little bit of a wild card because you don't know what inflation is going to run over the next 12, 24, 36 months. So it makes it really hard to predict. When we're looking at financial plans with clients, we're typically going to be adjusting and updating those annually. To identify, do we need to adapt our expenses or anything about our lifestyle in order to remain, to keep our high probability of success in retirement. So again, this is where that's a really important part of financial planning, especially in retirement. And I hope that helps you understand how inflation can be really dangerous if it happens early in someone's retirement. Now, here's the other thing. Inflation can sometimes, we saw this in a really bad way in the 1970s, but you can kind of get a second wave of inflation that comes after that initial wave. And when you look at the deficit spending that the government is doing right now, you look at what's happening with quite a few commodities, the precious metals out there, gold hitting all-time highs, silver on a big run, copper's been moving higher. You look at a Bitcoin moving higher steadily. You wouldn't be surprised if we do get another wave of inflation. So those folks who are looking to retire, let's say 2025, 2026, 2027, 2028, I would say this needs to be really top of mind for what you're planning for. And of course, there are some folks out there who really get to a stage of abundance with their level of assets, and they're more insulated to it. But you know, there's a lot of folks who are right there. They're comfortable, but they don't have a huge cushion for a big wave of inflation, and it's just really something to watch. All right, a last thing. I wanted to do the IPO RIP. Have retail investors benefited from this surge of IPOs that have hit the market? Chances are, if you were buying bullish on IPO day, headquartered in the Cayman Islands, not always a bullish ingredient for a company, but okay. If you bought bullish on that IPO day, you are down a lot. If you bought Firefly Aerospace on IPO day, you are down a lot. I mean, falling almost daily at this point. If you bought Figma on IPO day, you're down greater than 50%. Absolutely. If you bought CoreWeave on IPO day, you've actually done okay. But if you were kind of buying into some of that strength, you're down from 100. The peak was 187, and now you're sitting at 87. So that's a very deep drawdown. Call that a deep drawdown. If you bought Circle on IPO day, you've hung in there. But remember, Circle peaked at $298 per share. So you're in a very deep drawdown there. Chime, you know, you're down heavily after IPO day. You're sitting at the lows of the stock, all-time lows there. And Webull, you've SPAC'd at about $60 a share, and you're down at $13 a share. So very deep drawdown there. You know, as you think about these IPOs, they can be exciting. You just want to really pick your spots very carefully. Let's imagine that you've put $10,000 to work at kind of one of these nasty peaks here right at IPO, and you're looking at maybe that's turned into 5,000 really quick. To recover that loss, you're going to need a 100% gain, and maybe that 100% gain comes in one of the IPOs, just a lot of volatility. Maybe that 100% gain has to come from somewhere else, but that's a real issue in a portfolio. And I don't know the exact quote from Charlie Munger, but it's like one of those classic Charlie Munger, Warren Buffett quotes. It's something to the effect of, you don't want to miss. You don't want to miss big. If you really miss big on something, the setback in a particular portfolio can be really tough to overcome. So you want to, as much as possible, focus on quality holdings that can have proof of compounding, compounding capabilities over time. Anyway, that's all I have for you today. I hope everyone has a great day, and we'll see you tomorrow.